Hi, thanks for joining us on our webinar today. This is actually the first in a series of what we're calling Fast Facts webinars. Today's webinar is called Finding the Balance, Dues and Membership. Just as a little FYI, we're having our next webinar on June the 19th. That webinar is going to be around food and beverage, ending the boardroom debate. So we're going to specifically address the age-old argument of is food and beverage an amenity or a profit center? And I'm sure that one will be interesting as well. Today we're going to focus on the importance of a club's dues engine, its relationship to the overall health of a club, and then some things to consider when looking at and optimizing your dues engine. We are going to try to stay true to these being fast fact webinars, so we have a lot to cover in about 25 or 30 minutes, and we hope to just move right along. And as you have questions, feel free to enter them into the chat area, and we'll address them as they come in, or if you want to follow up with questions after the webinar, we can answer those as well. Today's session really, again, talking about dues and membership, and it's not really about giving you a magic answer on what the right level of dues is, what all the answers are. Today is really more about, I think, giving you some information so that you can actually ask the right questions, and then through asking the right questions, really figure out what the right thing to do is for your club. Quite often, it's not about someone having the silver bullet, the magic answer, but it's really digging in and asking the right questions and figuring out what the right thing to do is for your club. So we have the concept of a dues engine in club benchmarking, and it's a pretty simple metaphor. It's basically a two-cylinder engine. We view dues revenue as a two-cylinder engine. One cylinder being the number of members and the other being how much dues each member pays. And obviously the output of that engine is ultimately the dues revenue that the club generates. Now, all too often, clubs tend to focus really on what's the dues. That's what they ask each other. What are your dues? How much are your dues? And you really need to step back a little bit and say, well, what are we really trying to accomplish with dues? What we're trying to do is generate a certain level of revenue, of guaranteed revenue coming into the club that really has no direct cost associated with it, so it becomes a significant percentage of the cash that we have to run the club, and we'll talk about that in a little bit more in another minute. Ultimately, everybody's dues engine is a little bit different, and understanding your own and optimizing it correctly for your club is really what this is all about. So there's a balance between the number of members and the dues each member pays, and that balance kind of varies all over the place depending on what you're trying to accomplish with your club and whether you're in a good position right now or perhaps in a struggling position. It's a relatively simple concept, but again, folks tend to focus a little bit more on dues and not on the dues revenue that gets generated. When we take a look at one of the basic charts, this is a basic chart out of club benchmarking that our members run as, I think, one of the reports, the available cash report, I believe this comes out of. But we're not going to talk about, the my club aspects of it today. We're really going to talk about the industry, so we're going to be referencing the curves more than individual clubs. But when you look at dues as a percentage of a club's total operating revenue, we find that for clubs with golf, generally the median point for that is right around 50%. So 50 cents on every dollar of operating revenue at the median of the industry is dues revenue. So certainly that puts it in some relative perspective that, hey, it's generally about half the revenue of your club. Clearly it's critical to your club. And what we find is the clubs that are down in this lower quartile, down around 45, 44%, even lower than that as a percentage, they really struggle. They fundamentally aren't producing enough dues revenue per dollar of overall revenue to support their club. And quite often you find those clubs in varying degrees of producing operating deficits at the end of the year as opposed to surpluses. Then you have clubs on the other end of the spectrum where their cash is, as we call it, a little more liquid than most other clubs. So though they're dues rich relative to their operating revenue. And generally speaking, that's a good position to be in if more of your revenue comes from dues, and we know that there's really no variable cost associated with dues. It tends to get you started in a pretty good direction. There is some variation in the industry when you look at the this metric or this ratio relative to the different types of clubs. Clubs with golf, as we just saw, the median is about 50%, so 50% of the operating revenue comes from dues. For city and athletic clubs, it's a little bit lower. About 41% of the operating revenue comes from dues, and for yacht clubs, it's even a little bit lower, about 37%. So you could, perhaps draw the conclusion that it has decreasing level of importance for those other clubs relative to clubs with golf, let's say. But there's really another way to look at this. There's, I think, a more telling perspective that places the importance, the significant importance on dues revenue. And so that's when we look at dues relative to the amount of what we call available cash. If you're not familiar with the available cash model, we don't have time to go into it now, but you can also think as available cash as the gross margin that the club produces. Essentially, we net out some of the major operating departments, and what you end up with is the pile of cash that the club generates to pay for all the fixed expenses of the club, like G&A and the course and the buildings. And so it's the amount and makeup of your available cash is really a very important and critical piece of the business model of a private club. And here, when we look across the spectrum of different club types, we find that, obviously dues is a significant proportion of the available cash or gross margin that a club generates. For clubs with golf, it's about 78%. For city athletic clubs, about 66%. And for yacht clubs, about 81%. So generally speaking, let's just say about 75 or 80% of the gross margin of the real usable cash that clubs have to pay and fund many of their functions comes from dues. So if you have an anemic dues engine, you're really challenged to pay for all those other things like course maintenance and G&A, et cetera, because you fundamentally don't have the cash you need to pay for them. There are other places that you can get revenue. For instance, food and beverage often generates lots of revenue, and you can do things to generate more food and beverage revenue. But as we all know, and we'll learn more in a month from now at the next webinar, food and beverage, for the vast majority of clubs, doesn't throw off any cash. In fact, it consumes cash. It requires a subsidy of available cash. So this is just a way to reinforce that the dues engine and the output of the dues engine is a critical thing to the club, and it is intuitive, but now we've got some numbers behind it as well. There's an interesting relationship that happens when you look at a club's dues engine and then its net operating result, and you kind of tie it to the value proposition of the club relative to its membership, the value proposition that those members see. And so we're going to look at a couple bookended examples here to give you a feel for what I'm talking about. But on one end of this spectrum, you can have a club of a particular size that might have a lower than typical number of members. We call them full member equivalents, but a lower than typical number of members at the club. Each member pays a higher than the norm amount of dues to be a member at the club, and the net operating result of the club is a deficit, a net available cash deficit. Now, this is unfortunately a not all too uncommon occurrence we see in clubs. What's typical is, the clubs get themselves in trouble and they seem to be bleeding or have hemorrhaged members in the past. In order to try to compensate for that, they start increasing and jacking up the dues level, but ultimately you really can't balance the books on a shrinking membership. So no matter how hard you try, and frankly it's to the frustration of those loyal members that remain on, despite the fact that you've had this increasing dues level, the club still operates at a cash operating deficit and ends up having to do assessments or perhaps steal from cash reserves or from capital income to just fund their operations. So that's one end of the spectrum. We see on the other end of the spectrum a very healthy place to be, and that's where we have clubs that have a membership level, membership count higher than is typical for their size. The dues burden on an individual member is actually lower than is typical, and the club produces a net operating surplus at the end of the year. So that's the other end of the spectrum, and that's obviously a pretty positive place to be. When we visit those clubs, you can kind of tell it's got a large membership. It's very vibrant. The club is very active. People are generally very happy because they often recognize that, hey, we're getting great amenities, but in fact, because we have so many members, we're actually having a lower financial burden. It's not a lot of money for us to be a member, a member of this club. And then at the end of the year, we're actually producing positive cash results, which get thrown into capital fund, which helps keep the club healthy, and et cetera, et cetera. So it's kind of a self-sustaining, very nice place to be. So when we kind of then tie all that together, we have what we consider 4 sort of categories that clubs fit into, and obviously there are gray points in between all these categories, but this is how we sort of think about the relationship of member count, dues, operating results, and the value proposition of the club. What we see is, for clubs that have a typical member count, a typical dues level, and is generally about a break-even operating result, we kind of call that club in balance relative to its value proposition. Things are healthy, it's moving along, and basically the club is funding itself from an operating perspective, and they're in good shape. Then you get the clubs like the ladder we just talked about, which was they have a higher than typical member count, a lower than typical dues burden per member. They have a positive operating result, and we call that a balance plus value proposition. And I think a lot of folks know these clubs when they visit them. They can see it. They look at it and they just say, this club is vibrant, it's healthy, they've got new facilities, they've got projects going on, members are happy, and then you find out what they're paying in dues, and you're kind of shocked that often it's lower than you would think it to be. It's the clubs in the area that everybody wants to join because their members are very high endorsers of the clubs because they feel there's great value. Obviously, the opposite of that we already talked about, lower member counts, higher burden, not quite getting there, so you have an operating deficit, and we're just calling that basically an imbalanced club. And often it's really because the dues engine is out of balance, and you don't have the right mix of member count and dues, and it's just out of kilter. And then finally, you can have clubs which have some of those same attributes, a low member count, a higher than typical dues for the size of the club, but they're throwing off an operating surplus. And quite often those are the exclusive clubs. They're the ones that, they might only have a cap of 250 members or 275 members, and the members are paying, significantly higher than is typical for dues, but they're paying for that exclusivity. And the business model of that club is built around a small member count, paying higher exclusivity, and you've got typical cultures in those clubs, which often don't expect the same I would say broad-based amenities that other clubs do. This might be exclusive golf clubs as an example. So when we look at the dues engine and the clubs that face the issue of having an anemic dues engine, you really come down to one very strong fact or belief, and there is no substitute for dues revenue. Lots of people chase food and beverage as a way to patch up an anemic dues engine, and really that's just sort of smoke on the real problem. If your problem is your dues engine isn't putting out sufficient amount of revenue to support your club, based on the ratios and some of the things we've looked at, there are certainly other things to look at. Raising F&B minimums and getting more people in on Wednesday night to eat dinner is not going to solve the problem. We all know that the dollar spent on a la carte revenue probably costs $1.10. So that's clearly not going to produce any cash that you can use to fund other areas of the club. Likewise, while weddings and banquets, are perhaps have a little bit better contribution margin than a la carte revenue, it's really not a substitute for dues revenue. One of our members a few months back gave us a phrase which we really like, which is you can't cook your way out of a weak dues engine, and that makes complete sense. And we all know that you can chase those, but if your problem is not enough members or not the right dues levels, because you haven't raised dues in 5 years or whatever it is, if it's that dues engine, focus like a laser beam on it and don't try to say, well, people don't want us to raise dues, or it's really hard to get new members, so we'll just do this instead. That will bring you down a very bad path, because ultimately you have to focus on the problem at hand. And if it's dues revenue, it's dues revenue. Finally, it's a pretty tempting trap that, when clubs run into operating deficits because of a weak dues engine, they often try to look at and steal capital income. So they might take some of their initiation fee income, they might steal some of their capital assets, they might take money out of their cash reserves to patch up, operating deficits. That is a slippery slope. I mean, especially if you're doing it on a year-over-year basis. Obviously, if you're stealing from capital, you don't have the money to fund projects or fund repairs or fund, renovations as you should, which tends to make the club a little bit more tired, and that makes it tougher and tougher to attract new members, and so you go down this spiral, which is very hard to pull out of. So, patching up a bad dues engine with capital income might work for a year, but you better focus on the real problem at hand. So it's interesting, it took us a while to try to think about this, but one of the questions we hear most frequently in the industry, and we think it's a dangerous question, is clubs asking each other, how much are your dues? What are your dues? What are your dues? Did your dues go up? Did your dues go down? And that may have a little bit of value from a local marketing perspective, just understanding, what your competition, if you will, is like, if in fact you have clubs that are considered competition for you in your area. But the reality is, how much another club charges for dues has nothing to do with what you need to do relative to your dues engine. How much another club charges tells you nothing about the health of their dues engine, whether they're running an operating deficit or an operating surplus, how many members they have, what's the business model of their club, how much dues revenue do they need. All those questions don't get answered, and frankly, the dues that they pay have nothing to do with your own dues engine. And how much do you need to generate out of your dues revenue? And are you currently running a surplus or a deficit? And are you struggling for members? And so it's a very dangerous question, because if you happen to get an answer back that maybe the dues is near your dues, and you kind of convince yourself, well, I guess we're about right. It's a complete, it's an answer that's not complete. It's out of context, and it's often dangerous because you think you've got a valid data point and you really don't. It'd be like in a baseball game, hearing a score, Red Sox 8, Yankees nothing, no answer. If you only have the one data point, you don't get the full picture, the full story. And so when you're trying to balance your dues engine and your dues revenue, you really need to have the full picture of the club in context and looking at some of these ratios we've talked about, but certainly there are others, and you need to have the whole club in perspective. So very important, and really try to, and if your board starts going down the path of thinking they're gathering vital information with this question, we can help you with that. So, when you get to, we're pushing this metaphor of a dues engine pretty hard, but, we think it's pretty simple, and it gives the sort of the mental picture that we think is very valid. And there are some good maintenance practices and bad maintenance practices, just like in a real engine. And so, we hear a lot. We talk to, hundreds and hundreds of clubs, and while we can't reference all the stories here, we can, reference some of the things that we hear fairly typically. So things like, we haven't raised our dues in 5 years. And, that's a red flag. That's a danger sign. Clearly, costs have gone up in 5 years. Expenses have gone up. And quite often you might hear even a board member speaking like that as though it's a badge of honor, that they're proud that they haven't raised dues in 5 years. Well, I'm guessing if you talk to the GM or the controller, they might have a different perspective, because they know that, if you're running at your dues level 5 years ago, you very, very likely have not maintained your dues engine to the level it needs to be. The only exception might be perhaps if your member count has really, really taken off through that time frame, and that's really kept your output in balance, then maybe it's okay. But other than that, that's not a good thing to not raise your dues. In fact, I'm going to talk more about that. The board can't agree to raise dues. Well, you know what? If the board doesn't have the facts, if it doesn't have a view of the club's business model, whether it's through the available cash model because the club is a club benchmarking subscriber, or through some other method, if they don't truly understand the criticality of that dues engine and A, that it's important, and B, where they are, then how can they possibly agree? Because if you don't have those facts that everybody can align on, well, you've got, the 10 or 12 or 13 different opinions, and obviously, we use the phrase that opinions divide and facts align, and it's very, very difficult to get, dues decisions when you're using opinions rather than facts. Things like we haven't raised dues in 4 years, but we have an operating assessment every year. Well, that's a shell game. I mean, if you have an operating assessment every year, and maybe it's even going up a little bit every year, well, you're really playing politics. It really is dues if it happens every year. If it happens once every 10 years, all right, it's an anomaly that occurred. But, it's a political game, and we like to have clubs put process over politics. And this would be a case where if you just called it dues and got over the culture issue around raising dues, then it would be a little bit easier, a lot easier probably for everybody, and the board and the members would understand the business model of that club, better. Finding new members is really hard, and it is really hard. In this environment, it's not easy, and but if that's what you need to focus on, then that's what you need to focus on. I can tell you this, if there are two clubs in an area, and one of them, and they both need members, and one of them is focused on getting members, and keeping a healthy dues engine that way, and the other is not, and they're instead trying to go out and chase banquets, thinking, well, we don't have enough members, so let's go find banquets. I can tell you which one is going to get the members. The one that focuses on getting new members is going to get the members. So, focus on the issue at hand. If you need more members, it's hard, but focus on getting new members and put a program in place to make that happen. The not on my watch theory, again, a little bit of a badge of honor for, maybe there's a president on the board and says, nope, there's no way I'm going to, hit my members with a dues increase. And, clearly that's showing a lack of understanding about what drives the club, what really matters to the club, and what's going to become a sustainable model for the club. So that's a bit of a danger sign as well, and really not a valid governance perspective for sure. And then finally, we're full, but we're still short on cash. Why is that? We've run into clubs, and a lot of clubs have set their capacity for full members, maybe 75 or 100 years ago. We've run into clubs where 4 or 5 years ago, when times were good, they actually lowered their membership capacity from 400 down to 300. Now they have 290 or 295, and they're wondering, why are we short on cash? We're full. How can we not have enough money to operate? Well, maybe they haven't raised their dues in the last few years, and the reality is, they think they're only 5 or 10 members short, but perhaps that club was built and designed and has the structure, culture, cost model that really requires 350 or 400 members. So they might think they're only 10 members short, but they might be 50 or 100 members short, and that changes the perspective if you think you're 10 members short versus 100 members short. So, in some cases, clubs should look at, in balancing this dues engine, do we need to actually change our capacity restrictions so that we, in fact, are focused on the right number of members and then can focus on the right dues level? If you're off on one, by definition, you're going to be off on the other, and it's a hard place to be. So in terms of positive maintenance, I think it's understanding the key ratios and business models in context that drive a club. We think that club benchmarking subscribers have an excellent view of that through the available cash model, through a whole range of ratios that get generated automatically, based on filters they set. But however you do it, use facts and understand the entire model. Don't just grab individual data points. You need to see the whole. A club is a business. You need to see the whole business of the club in context with the related data points, as we've talked about here, dues and member count. So train your membership every year. Expect a dues increase. Again, it's often viewed as a negative thing. We're very strong proponents of raising dues every year. Hey, maybe it's 0.25%, maybe it's 3%. It doesn't matter, but train your membership such that, hey, in this club, the culture is dues increases every year because costs increase and service expectations change, and we're going to maintain a healthy club, and we maintain a healthy club by making sure that the coffers are being, filled at a rate that's commensurate with the expectations of the membership. So the clubs where it's viewed as a failure of governance or a failure of management to have a dues increase is completely the wrong perspective, and it's one that should be attacked head on. Showing your members, training your members to expect a dues increase is, we believe, quite critical. Obviously, know the facts, assess your club using reliable data. If you don't know where you are, it's very hard to get to the right place, and facts and data help you do that. Obviously, don't treat capital income as dues revenue. We've already talked about that. Bad place to be. And really, if your issue is a weak dues engine, focus on it. It's only going to get worse. The more you kick the can down the road and don't focus like a laser beam on those issues, it's harder to really get to that rock bottom place and then come out of it. So. Maintenance is better than a rebuild, I guess would be the term in terms of carrying this metaphor forward. Why do we do all this? We're going to, next is Q&A, but we really do believe, we've seen, now working with hundreds and hundreds of clubs, we've got 500 subscribing clubs, but healthier clubs, more empowered managers, and more strategic boards do result by elevating fact over opinion. When you run with opinion in the boardroom, it's very hard, A, to identify the right things to work on, B, align on what should be done about those issues, and C, execute them with the proper expectations. If you don't have good measurements and good facts, how do you know where you're going and when you've gotten there? As I mentioned, there is another webinar in a month, a little less than a month, F&B, ending the debate in your boardroom. I think you'll find that very interesting. It's a great topic. We love talking about it. In terms of Q&A, there have been a few questions that have come in, so I'm going to just answer a couple of those. One is, we talked about the most dangerous question, the what are your dues? So the question is, what are the right questions to ask? And that's a great question, because often the right questions to ask are not simple things like, what are your dues, what's your cost of food, just data points. It's bigger picture questions. It's, what is the business model of this club, and is it sustainable? Because by asking questions like that, it sends you down the path of, well, in order to answer that, what do I need to know? What do I need to learn? Where do I get that data from? So it's the big picture stuff that you want to understand, and that helps guide you then down the path to the questions. If you understand the big picture and you look at, where my cash comes from, where my cash goes, you can understand things like the dues engine, and are you allocating your funds that are in a way that are basically in line with the industry, or are you off in some tangent somewhere? So that's a good one. Another question that came in was, how do we get aligned on the same set of facts? And it's not a silver bullet. There are, wear a service. There may be other ways you can do that, but until you replace opinions with facts, you're going to sit around the boardroom or management meetings, and everybody throw out their opinion, and I guess decide whose opinion you're going to use. So, facts align, opinions divide, and you need to come out of, whether it's a management meeting or a board meeting, you need to come out with the perspective of we know, as opposed to I think, right? If you're going in the room with I think this, and everyone has their I think this, I think that, I think that, the odds of you coming out with a we know are very slim. So you need to go in with facts so people can align on the facts. And finally, I'll just leave as a parting message, we are strong believers that good governance and management is more about asking questions than it is about thinking you have the answer. It's the rush to judgment, the I know the answer, that is often to the detriment of clubs. And so, asking the right questions in life is often more important than thinking you have the right answer. So with that, we will close today's webinar. I appreciate everybody joining us today, and we look forward to seeing you in another month. Thank you.